Good afternoon. I'm David Buttry. I'm Chief of the Applied Economics Office at NIST. I'm joined this afternoon with three excellent speakers. Chuck Chadovitz, Vice President in Environmental Affairs and Sustainability at the U.S. Chamber of Commerce. Daniel Kanuski, the Managing Director of Public Sector at Marsh McLennan, and Ron Iguchi, President and CEO of ImageCat Inc. I'd just like to first just kick it off with a couple of remarks before I turn it over to our panelists who have prepared some presentations before we get into the questions. You know, it's interesting. I was just kind of reflecting on the day, looking over the agenda and what we've heard so far, and kind of thinking about the economics of resilience and disaster modeling over time. At least that I've been involved in thinking back 10, 20 years, looking at measuring the economics of whether it's building codes, standards, technologies, interventions, whatever it might be. And it's really interesting, where the field has gone to, and it's exciting. I think back, 23 years ago, a lot of the modeling was focused on very direct things that could be measured, right? It's buildings losses, insured losses, direct damages. Those are the things that were measurable, they were quantifiable. A lot of the economic modeling, that's the data that was used. Over time, I think there was realization there's other things, there's other impacts that are going on in society, right? There's these non-disaster related benefits, cost, impacts, and as the research and science has started to evolve, started to capture some of that. But it's difficult because a lot of these things are very challenging to measure. Damages to buildings a little bit more straightforward, it's observable, but some of these other things are much more challenging. But over time, we see in the economic models that if you have good data, you can start coming to some of these solutions. But you start recognizing that if you don't have the right necessary data, it brings a challenge. You also recognize that there's a lot of different stakeholders involved, and they have different incentives, and they're affected much differently. So when I look at the topics over today, talking about damage avoidance, losses, costs, different types of strategies, and thinking about these other non-disaster benefits and impacts, I start to think of there's real opportunities, and I think that's what this session's about, to think about as investments are made into resilience, what opportunities? It's not just how do we avoid losses, but if we make investments in a strategic manner, are there opportunities for economic growth and other types of opportunities? But it requires a lot of folks to get together and have discussions. And I think economics provides a framework. It's not the maybe only discussion. We've heard earlier that economics is a piece of all of this. There's other considerations, but it provides a framework to have discussions, to bring stakeholders together, to talk about issues and derive at new and unique solutions. So with that, we'll dive into today's session, and I'll turn it over to Chuck.
Well, good afternoon. Thanks so much, David. Thanks to NIST, NOAA, and ASCE for including the Chamber in this discussion. I'm pleased here to be with my fellow panelists, Dan and Ron. We've been on several panels together over the last month or so, and so it seems like this is a conversation that's getting some momentum. And as David mentioned, we've heard a lot of the things that we're going to touch on today throughout the day in these other parts of the discussion. I had a few things that I was going to talk about, and we have some slides here. Can we go forward? Let's go. Well, see, we've talked about this already, so we can go to the next one. So let's just leave it on that one for a little bit. And Mary Claire talked about this this study a little bit in their session. But when we think about why the business community cares about resilience, it's things that Darren mentioned this. When the bridge goes out and your customers can't get to buy the product or service, or your employees can't get to work, that's a problem for the business communities. And so these are real material risks that companies are facing. And so it's in their interest to think about these issues. So we did a little bit of research in cooperation with our foundation and with Allstate to look at the NIBS study, which you all, I'm sure, were familiar with. So what NIBS came up with was a basic ROI on federal investment. So for every $1 invested, you get $6 in reduced losses returned back to the taxpayers. And maybe JQ has a little bit more detail that he wants to put around that if I've got things wrong. What we did is add the economy to that it's really important that we think about what the economic impact will be for investments ahead of the next disaster. So what we found was if you invest $1 in pre-disaster mitigation or preparedness, you get $13 in reduced losses and economic savings. And so that doesn't mean that losses are going to be eliminated. What it does mean is that the impact on the economy on GDP, jobs, and income is going to be less. And so what that means, and we've talked about that throughout the day, that people and economies will be able to recover more quickly. That's really important when you talk about all the things that were mentioned in terms of the market signals that were mentioned in I think it was the session before this or the one before that, where Holly discussed the market signals that are out there. When investments are made, and when you think about what insurance companies and what investors can bring to the discussion, if you do retrofit your building, if you do invest ahead, will business be able to give you benefit for those investments? And so is it a reduction in basis points on your loan? And that was discussed in that session as well. Is it a reduced insurance premium? All those are things to think about that can be incentives for making these important decisions ahead. We've also had a number of conversations where again, it was discussed today, what's the right intervention point for making sure that people can make these investments at the right time? And so is it when they're buying a house and financing that? Is it when they're refinancing it? When can the investment community come and give the signal that if you invest in these, if you do these things, then you'll get the economic payback? And I would argue that most things that we've talked about today, where it's going to be, where there's going to be some social and other impact that you might feel, that the economy is part of that discussion. That people, when they make these decisions, they're thinking about, they're self-interested, that they want to do it for those reasons. The last thing that I'll mention is that this is a really hard discussion. And Dan and I, Dan was on a panel that we had at the chamber last week, and he did a couple of things there, and we talked about it then, is that people want that $1 now. They don't want to wait for the $13 later. And so that's a really difficult cost-benefit argument to make, that look, if I don't have to make that investment and now, and maybe I get impacted by a natural disaster, maybe I don't. And so those are all things I think that we need to consider. And I'm happy to dive into any of these other discussions that we've had today, and welcome the conversation with our colleagues.
Thanks, Chuck. If you turn it over to Dan, please.
Next slide.
Great. Great to see everyone. Chuck, that was a perfect tee-up. So incentivizing resilience, one way to do that is exactly what Chuck just said. If we know there's that return on investment, and thanks to the report from the Chamber and Allstate, we now know that that return on investment isn't just what we traditionally thought of, but actually more so, the economic benefits. So let's pull that thread a little bit. The reason we care about the economic benefits is because there are significant economic costs. Those economic costs are the result, my view, of large degree of underinsurance and uninsurance for a number of reasons that I think were probably discussed today. So it's, to use the insurance term, there is capacity out there. There is insurance available. For example, let's look at the third item there, like flood. 6% of Americans have flood insurance. I would bet that if there was a significant increase in demand for flood insurance, we'd find a way to get everyone flood insurance. And that's both because the NFIP requires the provision of flood insurance to anybody who wants it, and because you've seen increased interest from the private markets. But what we have right now is described by the insurance industry as a protection gap. There's a gap between the economic losses and insured losses. We need to close that gap. Next slide. So how do we close that gap? Well, ideally we'd incentivize that. Chuck and I often joke around, like, we look at carrots. Yeah, we're looking for every carrot we can find. There's plenty of other ideas and advocates out there for sticks too. Nothing against the stick approach, but if you're going to use the carrot approach, we need to identify who benefits from these investments. So those who benefit, which at a minimum that includes the finance, insurance, and real estate industries, and I chair the Finance, Insurance, and Real Estate Committee for the National Institute of Building Sciences, which is where this is from, and there's a QR code there if you want to scan it. But that links to a report we did a couple of years ago that was it was called the Resilience Incentivization Roadmap 2.0, and for those of you in the marketing world, you realize that's probably the best title. But it was written by a bunch of engineers, nothing against our engineers in the room, and engineers speak to facts. And the facts are we need to build a way of incentivizing these industries to do so. And as was mentioned, I think, reducing points on a mortgage would be a good way for a lender to help out. And of course, the insurer is always what we jump to first, which is insurance discounts based on risk reduction. I think that's a little oversimplistic. For those of us in the insurance industry, we know that the insurers price according to risk. Again, I'm not an underwriter, and my firm doesn't do underwriting, but based on my knowledge of the insurance industry, the insurers certainly price according to risk. So if you reduce your risk, you should see a reduction in premiums. That's an obvious way that the insurance industry incentivizes. But there's a number of other stakeholders here that you can see on this array of stakeholders, and they would be co-beneficiaries. And the first step to solving this problem and to developing these incentives, in my view, is to identify those co-beneficiaries, because if we can help those industries and those stakeholders understand that they're benefiting, maybe, just maybe, they will put some investment forward. And if all of that investment is made by all of those stakeholders, then pretty soon you will see a sufficient motivation for that individual, for that business owner, for that government, for that stakeholder to make that investment, and we will all benefit. Next slide. So what are some areas where we see some shortcomings at the community level? Because that's where the rubber meets the road. We can talk about FEMA, we can talk about all these federal agencies all we want, but at the end of the day, the rubber meets the road at the community level. And so there are some barriers we have to overcome, and I know I'm short on time, so you can look at those at your leisure. Next slide. What is a solution? One solution is community-based catastrophe insurance. That's something that our firm offers, and there are a number of other firms that are offering similar solutions, which is essentially helping communities protect the most vulnerable against the financial consequences of disasters by setting up a parametric solution. Parametric solution is a type of insurance, or it doesn't even have to be insurance, frankly, whereby if an event happens, then a payment is made. In other words, a triggering event occurs and a payment is made. There's a lot of benefits for that, as you can see. Next slide. And at the end of the day, none of us are going to solve this problem alone. There's no silver bullet. If we go back to where we started and where Chuck led in, there's that economic loss. We can reduce some of that economic loss through risk reduction, through hazard mitigation, etc. And then I talked a little bit about insurance, both through traditional insurance, like homeowners or business insurance, or specialty insurance that many homeowners don't realize they don't have, like we said, like flood insurance, and innovative solutions like community-based catastrophe insurance and parametric insurance. By pairing that risk reduction with risk transfer, we can significantly close this gap. At the end of the day, what we could then focus on then is that what is that remaining gap? What is the resilience gap? What else do we need to do to close that remaining amount? But I think through risk reduction and risk transfer, we can get a long ways down that road. So with that, I will pause and turn it over to Ron.
Thank you, Dan. Okay, we got my slides up. All right, well, it's great to be here, albeit virtually. I've been able to attend some of the earlier sessions, and one of the topics that I think has been very pertinent has been the notion of return on investment. And the topic that I decided to focus on, or at least the element, is how we estimate these future savings from mitigation activities. Having been involved with the NIB studies, in fact, the very first study in 2005, I was the technical director. And then more recently in some of the 2019 studies, I've got a pretty good perspective on some of the issues, challenges, and some of the priorities that I think we need to focus on moving forward. Okay, could I get the next slide? So the aspect that I'm going to focus on is the return on investment for lifelines. This is a topic that I've been very involved with for many years. And I think we all know lifelines are pretty important, for our communities. They consist of water, wastewater facilities, power, communication, and so forth. And one of the aspects that I always like to emphasize is that lifelines are essentially interdependent systems. We know that water depends on power to deliver services. Communication is very important. So these are things that I think that we're beginning to better understand, that we can't evaluate the performance of these lifelines in silos, that we need to consider the interdependencies. One thing that I'm very concerned about is that I think that we're moving towards what I would consider a perfect storm. We see that our lifelines are very old. They require repair, replacement, very important maintenance. And I think for that reason, they make them, they are very vulnerable. The other thing is that disasters are becoming more frequent. They're more severe. And I think that, this is a very serious concern that we need to acknowledge. And then the other thing is that I think our institutional systems that are needed to ensure resilient lifelines, I think quite frankly, failing. I think we need to do more to make sure that the priorities that are key for lifelines and their importance for communities are considered in terms of codes and standards and so forth. So unless we do something to prioritize, the importance of these lifelines, I think that we're going to be headed toward this perfect storm. Next slide, please. So I thought what I would do is I would discuss the methodology that we've used in the past to estimate what these future savings are from mitigation activities. And there are four key components that are part of this methodology: hazards, asset exposure and vulnerability, how we measure losses, and then how do we consider adaptation strategies and activities. When we think about hazards, I think there are two things that I think are very important, and that is the likelihood and severity of the hazard, and then also looking at the multi-hazard perspective. So when we look at frequency, things like, for example, infrequent disasters, I think make it very difficult for people to sort of perceive, immediate risk or sense the urgency of that hazard. Hazards that are more frequent, I think, become a lot easier to motivate, people to act. Asset and exposure and vulnerability, there are several things that are important here. Structure information. We need to know something about the construction types, what these facilities are designed to. We need to understand, how old these facilities are and what the replacement values are. And much of the same information there is used to assess the vulnerability of these assets. I talked about system interdependencies, and I think that unless we begin to consider and acknowledge that lifeline systems, really depend on other lifeline systems, I think that we're going to underestimate what the vulnerability is for these systems. Loss measures are considered, I think, in various ways. Usually, we think about repair costs, how much damage has occurred. But there are other things like business interruption losses and losses to the community that I think are very important to measure and to incorporate into our decision-making process. One of the things that I think from a technical point of view is very important is considering the probability of these different hazards and their effect on these assets over time in estimating what the expected losses are. And I think for lifelines, what becomes also important is trying to incorporate the notion of recovery and restoration times, because I think that when you look at the impact of damage to these systems, it's really the disruption of that service and their effect on things like recovery after a disaster. Adaptation strategies are very important when you consider, for example, the specific mitigation measures. You need to consider the cost of the mitigation. I think also you need to be able to weight, for example, the different outcomes from the different events. We know that these disasters will occur in different sizes at different times, and the frequencies will always vary. And what we need to do is we need to look at the notion of a baseline loss result. In other words, if you don't have mitigation measures in place, what would be the expected loss? Then I think we incorporate the mitigation measures. We look at the difference of having the mitigation, no mitigation, and that difference there is the amount of savings that you will basically incur if you employ these things. And then I think that another thing that might be important is considering some of the indirect effects, such as cascading events or incidents. For example, maybe fire following earthquake or other hazards, I think, would become very important. Last slide, please. So we talked about in some of the other sessions, the return on investment. There were two studies that I was involved with. The earlier study, 2006, where we looked at the return on investment of FEMA mitigation projects. In 2019, subsequent studies focused on other types of assets, and it went to well beyond FEMA mitigation measures. For example, standards and codes and so forth, and their impact in reducing future losses. Last slide. So the point that I always try to make is that there are no resilient communities without resilient lifelines. And one of the things that I'm involved with right now with NIBS is the initiation of a lifeline infrastructure hub. And this is something that I think, is very important in trying to move forward some of the things that we think are very key, such as codes and standards, and also, to address some of the technical issues that I described earlier, which are the lifeline interdependencies. So this is this is the end. Thank you.
Thinking about questions and just thinking about what was presented, there's been discussions on return on investment and kind of general discussion of it. And I just wonder, if you've seen individual studies, and is there any commonality that you see in projects or case studies that have been evaluated that are common across several of them, where the return on investment was maybe high or significant?
Well, I think we modeled 25 MSAs across the country with communities of various size with different hazard profiles in each community. And we looked at what, if you cut the cost of the disaster in half, what is that going to do to, or at other rates, what is that going to do to the economic savings that you might receive? So we saw that there were certainly across individual hazards there were some commonalities, but each community, whether it's on the East Coast or not, would have different there'd be different concepts that they'd have to take into account.
Yeah, Dan or Ron, do you have any maybe examples? Again, looking for commonalities, things that might suggest, hey, this is a slam dunk, or this is might be something to pursue, research further, certain approaches.
I think one of the things that I think we always need to consider is the multiple benefits from mitigating, say, for one hazard. There may be benefits for other hazards, and I think that when we think about trying to sort of measure the accrued benefits, I think there is a very, very significant contribution by looking at different hazards. So I think that not just looking at say climate change, I think that there are other benefits for some of the other hazards. And I think the other thing is codes and standards. I think that when we begin to truly understand the vulnerabilities of these different facilities, and that we design for for these vulnerabilities, I think that we will accrue very significant benefits.
I think building on that, I think we now know benefits are there, right, through these multiple studies. The issue is helping stakeholders understand that they are benefiting from it. And, because the next step would be to get them to co-invest, right? If we can identify these co-beneficiaries and they are convinced, suddenly they become co-investors.
So thinking about different sectors and the different co-beneficiaries and the silos, I think it was a term used in one of the presentations. So silos suggest there's a communication issue there, and co-beneficiaries suggest that there's a potential benefit for collaborating or exploring options. So it sounds like there's opportunity there. So what opportunities, or what would need to be done to kind of maybe reduce some of these silos and kind of.
Well, I mean, Dan talked a little bit about the carrot approach, that incentives, whether it's through some of the things that were talked about earlier today, like tax credits or others for resilient buildings, are those kinds of things, can those help both communities and companies to co-invest in, for instance, infrastructure that might be in both their interests?
Dan or Ron, do you have a comment?
Yeah, I think the challenge is, obviously, if you're asking me to challenge my own argument, the challenge is convening those stakeholders and getting those stakeholders engaged. If we can get those from the built environment engaged, which you have here, that's a big step in the right direction. And then having the insurance industry represented, it's not just myself. I a number of other firms represented as well. So that's good. And then to look at some specific issues. And again, I mentioned at the community level, I think it's the most obvious level to engage. Where in that community, by the way, I saw in the questions, most of the time it's municipality, city or county government, but it certainly could go down to the neighborhood level. I mean, we have HOAs as clients, right? Big HOAs that are looking to manage their risk, both from a risk reduction standpoint and from a risk transfer standpoint. There are specialized solutions that they can take advantage of to help protect their community members. So for me, community is the place to start, and it's those local stakeholders on the ground. Again, it could be government. It needs to include government, but should also include, like I mentioned, insurance industry, the local banks and finance, the local real estate agents, the local real estate investors and developers and building operators. I mean, you can keep going down through the list, and looking at it in a specific context, in a specific community, I think is the most obvious way to do it. That said, we have conversations, and increasingly so having conversations here in Washington, with the trade groups that represent the real estate industry, the finance industry, the insurance industry, and having these trade groups that represent all of these companies come together at a high level and have these conversations. I think there's a benefit in doing that. And again, I've seen more of that even just in the last few months than I have historically.
And where are the intervention points where you can, where those investments are being made and the individual homeowner as part of that community can make the decision that they need to make?
I think when you have a quantitative assessment of what the return on investment is, that is what the savings are, I think it helps all the various stakeholders actually see where they benefit, and I think it would would motivate them more to think about how they can be a part of the process. If you think about some of the larger community losses, such as say lifelines being disrupted, affecting say local businesses and so forth, I think that that kind of assessment helps the individual stakeholders see where they can actually benefit and where the investments could be.
So switching gears a little bit, since we've got some engineers in the room, and thinking about how can engineers help understand what is needed or possible for improved return on investment? Chuck?
Well, I guess as an engineer, I think one of the things that we do very well is that we tend to be good ambulance chasers. Whenever we have a disaster, we are out there, we're trying to collect data, we're trying to understand what has failed, what the impacts are, and so forth. And when we begin to use that information, whatever data we collect, and we work with other stakeholders like government agencies and these sorts of groups, I think we begin to find solutions that would prevent these sorts of failures and damage from occurring in the future. And when we can translate that sort of information into more sustainable activities like codes and standards, then I think we're doing our job. But I think collecting the information, being able to explain why things failed, and how we can translate that into things like codes and standards are, I think, where engineers could help.
Sure. So I think we got about 10 minutes left.
Get a microphone.
I got one online after you take it. Thank you.
Thank you. Robin Kemper. Kind of broaden the concept of return on investment a little bit, and something that's been bothering me for quite a few years, and I don't know if any of you have brought this into all your thinking, but we know that a lot of our underserved communities are the most vulnerable to these hazards and disasters and everything. And when you try and bring in the factor of equity and you talk about return on investment, and all I've ever heard, and maybe I just don't know enough about it, it ends up being economics. Therefore, our underserved communities will not get that benefit because from an strictly economical model, they're not where you should put the money to get that bigger return on investment. Is there any way, or anybody looking on how to bring that into the formula when you're looking at returns on investment, and especially at the community level?
I mean, I don't know that that's true. I mean, I think there's been a lot of discussion about how that if you are going to make those investments where those most vulnerable live, those are most at risk, most vulnerable. And so they're the most at risk to disasters, and they're also the most vulnerable economically. And so there is that ROI is there to make those the investment in those places. I'm sure you're aware that a policy passed the community development and resilience zones, or community resilience development zones, CEDARs. And that's what it called for. It's called for identifying these most at-risk, most vulnerable communities, and then having that be a pathway for investment. Remains to be seen what's going to happen with that. I mean, it didn't come with money, and so it'd be up to Congress and the administration to decide how best to address that.
I have a related question. Bilal Ayoub, I have a related question. My concern, or one of the concerns, is the shifting perspective. If you look at the cost, it could be the homeowner. If you look at the benefit, it will not be. It will be the homeowner plus many other stakeholders, right? So when we look at, let's say, $1 leading to 13, or $1 leading to 6, the dollar will be invested by the homeowner, let's say, and the $6 will be damages that will benefit Home Depot, let's call it that way, right? Because they have to sell supplies. Always there is a surge in tools and products and supplies after a disaster, right? So how can you reconcile this shifting perspective? I mean, I understand the economic model and what we are trying to do in here, but the challenge is having the risk coverage done in a moral manner, meaning the bearer of the cost is the recipient of the benefits. If the two are not aligned, it raises really issues.
Well, I think you highlight that there are many co-beneficiaries, as I mentioned. You mentioned one economic co-beneficiary would be Home Depot, but I think it would be wrong to focus on that as as somehow more significant than any of the other stakeholders. The bottom line is everyone benefits by that $1 investment. Agree with you completely. The goal should be for us to align those co-beneficiaries around making that $1 investment. And I'm sure you've talked, there's a number of government programs, BRIC being one of those. I oversaw the BRIC program when I was at FEMA, and I was sorry to see it go away. That's an obvious example. Any of these government grants are obvious examples about how to incentivize. But, there may be less obvious ways, like I mentioned, from the other industries. And I think the more we can bring those industries in to show how they are benefiting and that they should contribute to that $1, we'll all be better off as a result.
And I don't know that it is misaligned, that the idea is that the homeowner would receive the 13, or at least a good portion of that $13 back. I mean, in terms of their own individual contribution to GDP, income, and jobs, that they get to, they are part of the community, and so they get the benefits of that as well.
Yeah, I got a real quick follow-up here, and really, Dan, maybe I can reach out to you. This is Dan Walker. I'm one of the co-chairs of the task force. you had that carrot diagram, which I thought is really kind of integral. If we're going to try to build a coalition of people to invest that dollar, how far has that analysis gone? I mean, to me, I'm kind of an old policy guy. If you're going to talk about actions, you have to talk about actors. So those carrots, who's going to create those carrots? Would it be a different entity? How far down that kind of analysis have you gone? Because I think that's really at the heart of this discussion.
Sure. So that NIBS report was from a couple of years ago, and it specifically focused on homeowners, and the peril was flood. And so how can we look at this from a homeowner's perspective with respect to inland flooding? I would say that the goal of NIBS as a follow-on would be to do some pilot studies around that at the community level, just like I described. So that would be a NIBS, a follow-on project that NIBS would like to do, as you know, if there's interest. I certainly can put you in touch with them. But I'd say more generally, the conversations are happening in a way they haven't before. As I mentioned, with those national organizations that represent all the different industries are coming together and having these conversations. So it's not just the insurance industry having this conversation with ourselves. You know, the fact that several major trade organizations representing insurers, brokers, reinsurers, the fact that they hosted a session here in Washington just about a month ago that I participated in, where they invited in the real estate industries, trade organizations. And I say the real estate industry, it's just like the insurance industry. There's many different aspects of real estate, from the realtors, the home builders, the renters, everything in between. And it was a great dialogue about how we both benefit from risk reduction investments, you know, the insurance industry and the housing trade organizations. But more importantly, and I don't want to lose sight of this, and I think Chuck said it right, at the end of the day, the biggest beneficiary is hopefully the one making the investment. It's that homeowner, it's that business owner, it's that, you know, the local elected official that puts up a big, flood mitigation project. That they and their constituents and they and their families are the beneficiaries of this. And frankly, it's, as you guys, I mean, as engineers know better than anybody, it's not just the financial benefit, it's the physical benefit. You're saving lives by taking these steps. That's incredibly important. So, you know, there's these intersections between life safety and economic benefit. I mean, Chuck mentioned one, which is you retain your job. If you can stay in your home, not only are you safe, but you're able to go to work. There's a lot of benefits to that. And I would argue the primary benefit is to that individual. But yeah, there's broader economic benefits as well as having the individual go to work.
And I think that from a policy perspective, we have a coalition of what I like to call unconventional bedfellows. It's a group of business, environment, conservation, state and local government, trade associations, all have a shared interest in resilience. And I think the key thing of that is that we talk about a strong federal role. There is a role for the federal government to play in this, and so we've certainly been talking about that. But every level of government definitely has a role in both preparing ahead and responding to these hazards. And so it's indicative that we involve all those stakeholders in that process. But it's a great question, and all of them need to be at the table.
I know we're about out of time, but
Yeah, David Frost, Georgia Tech, and going back to your original question, you said, are there engineers, do they have an opinion? So my tongue-in-cheek opinion is we shouldn't be trying to insure our way out of this problem, we should be engineering our way out of this problem. Now, having said that, if you look out the window and pick any tree you want, those trees, the roots of the trees are multifunctional. They have an anchoring function, they have a thermal regulation function, they have a evaporation function, they have a storage function for the trees. They're multifunction. Unfortunately, much of our engineering infrastructure has been built for single functions. And I think if we're looking for a real game changer building on the back of engineers, we should start looking at how we're building buildings with new multifunctional concepts. And I think if we do that, first of all, the benefits start to go to the owner and the developer, because now they can actually probably get a lot more for a lot less. And so I think we need to start thinking about that and not just carry on down the insurance will solve every problem. And I'm not trying to become an enemy of the insurance companies, but I think we have to look at the full problem. Thank you.
I think we would agree. I mean, the insurance industry would agree with you. This is not an insurance crisis we're facing. It's a risk crisis. And the way to buy down that risk is, as you said, could be engineering solutions.
So I think we got time for one last question from online.
This question is from David with Jacobs. His question is, can you tell us more about the findings, like NIBs trickle into public policy, like the PAPPG?
So that's a FEMA document, the Papa G. What was the specific question? How it trickles in? I mean, I'd say, first of all, we, speaking firsthand, we would not have had BRIC, the FEMA BRIC, Building Resilient Infrastructure and Communities program, had it not been for the science of NIBs. Had that report not come out when it did on the heels of Hurricanes Harvey, Irma, and Maria, we would not have had the necessary justification to get a multi-billion-dollar pre-disaster hazard mitigation program implemented. So science matters. What NIBS does matters. I feel passionate about that. I know Ron does. And that's why we volunteer with the organization.
Take one. That's it? Okay. Thank you, everyone.